Hello student, we are in the fourth video on the topic of terms in accounting. Let's check out the terms that we will cover in this video. 15th term, receipt. 16th term, expenditure. 17th term, revenue. 18th term, expense. 19th term, income. 20th term, profit. 21st term, gain. 22nd term, loss. And 23rd term, revenue from operations. So let's start with the 15th term, receipt. 15th term, receipts. It is the amount which is received or receivable. Both will be receipt. Amount received or receivable for, it could be sale of assets or sale of investments or sale of goods or for rendering of services. So when you sell assets or investments or goods or you render some service, any amount which is actually received or yet to be received, which is receivable, is referred to as receipts. There are two types of receipts. The first one is a capital receipt and the second one is a revenue receipt. So what are capital receipts? Capital receipts refer to amounts received or receivable against transactions which are not revenue in nature. So what is revenue in nature? The normal course of business of selling of goods or rendering of services, that is a revenue activity. When you receive amounts or amounts are receivable for transactions which are not revenue in nature, it is referred to as capital receipt. For example, when you sell fixed assets or when you sell investments, it is a capital receipt. The amount received or receivable on sale of fixed assets or sale of investments is a capital receipt. What is a revenue receipt? Revenue receipt refers to amounts received or receivable in the normal course of business for sale of goods or rendering of services. So, any amount which is received or receivable in the normal course of business. What is a normal course of business? Sale of goods or rendering of service. So, in this area, if you receive any amount or any amount is receivable, it is a revenue receipt. So, amount received or receivable for sale of goods or amount received or receivable for rendering of services, that is a revenue receipt. It also includes interest received, rent received and dividend received. So, this is a receipt, any amount which is received or receivable. If it is against a transaction which is not revenue in nature, it's a capital receipt. If it is relating to the sale of goods or rendering of services, then it is a revenue receipt. Sixteenth term, expenditure. It refers to the amount which is paid or liability incurred, which is the amount is payable. Amount paid or payable for purchase of assets or purchase of goods or for taking services. So for any of this, if you incur a liability or you pay an amount, then it is called expenditure. Expenditure is of three types. The first one is called capital expenditure. The second one is called revenue expenditure. And the third one is called deferred revenue expenditure. What is capital expenditure? It refers to expenditure incurred to increase the earning capacity of the business and the benefit of which is not exhausted within one accounting year. For example, when you purchase land or building or machinery or patents or copyrights, it is an expenditure incurred to increase the earning capacity of the business. And remember, the benefit of this expenditure is not exhausted in 1 year. The land is indefinitely with you. The building also stays with you for a very long period of time. So the benefit of that expenditure is not exhausted in 1 year. So that is called capital expenditure. What is revenue expenditure? When we incur expenditure, the benefit of which is exhausted within one accounting period, we call it revenue expenditure. For example, the cost of goods sold, salaries, wages, electricity charges, rent, all these are examples where when you incur the expenditure, the benefit of the expenditure gets exhausted in that one accounting year when you pay the expense. Employees work for you only if you pay salaries till they work for you. So the benefit of the salaries expenditures gets exhausted in that one accounting period. Same for cost of goods sold. So after the sale happens in that particular year, in the next year you will still have to incur expenditure on cost of the goods which have been sold. So if the benefit of the expenditure is available for more than one accounting period, for example purchase of land, building, machinery, we refer to it as capital expenditure. If the benefit of the expenditure is going to get exhausted within one accounting period, we refer to it as a revenue expenditure. Now the mixture of capital and revenue expenditure is deferred revenue expenditure. In this case, the expenditure is revenue in nature, but the benefit we get for more than one accounting period. For example, heavy advertisement expenditure or heavy expenditure on repairs and renewals. Now let's say a company incurs heavy expenditure on advertisement in the current accounting period. Now the benefit of that expenditure, people will still buy the product in the successive years. So we will divide the advertisement expenditure over the period for which the benefit of the advertisement will be there. So that is called deferred revenue expenditure. The expenditure is revenue in nature. It's an advertisement expenditure, so it's revenue in nature, but the benefit you can get for more than one accounting period. So what is expenditure? An amount which is actually paid or payable. You incur a liability for purchase of assets, goods, or for services taken. If the benefit of the expenditure lasts for more than one accounting period, we call it capital expenditure. If the benefit of the expenditure is exhausted in one accounting period, we refer to it as revenue expenditure. And if the expenditure is of revenue in nature and the benefit comes for more than one accounting period, we call it deferred revenue expenditure. Seventeenth term, revenue. It is the amount which is received or receivable in the normal course of business for sale of goods or rendering of services or use by others of the enterprise's resources, yielding interest, royalty and dividend. So amount received or receivable for sale of goods or for rendering of services, and also interest received, royalties received and dividend received. All these are also revenue. 18th term, expense. Expense is defined as the cost which is incurred in order to earn revenue. So any cost which is incurred in order to earn revenue is called expense. It includes the following: the cost of the goods sold, expenses such as salaries, wages, electricity expense, etc. It includes depreciation, which is decline in the value of fixed assets. It includes bad debts, which is decline in the value of current asset of debtors, and also decline in the market value of investments. So all these are costs which are incurred in order to earn revenue and are called expense. Let's understand the term outstanding expense and prepaid expense. Outstanding expense refers to expense which is due but not paid. Expense payable, it has been incurred, the expense, but it has not yet been paid. That is called outstanding expense, an expense yet to be paid. An outstanding expense is a current liability. What is prepaid expense? An expense which is paid in advance is called prepaid expense. You need to pay the expense only in the successive years, but you paid the expense in advance in the current year itself. It is a prepaid expense. A prepaid expense is a current asset. 19th term, income. Excess of revenue over expense is called income. So the formula for income is revenue minus expense. So this is the formula for income. Income is a broader term than profit and includes profit from the non-operating activities of the enterprise. That is, activities which are not related to the main operating activities of the enterprise. That is called a non-operating activity. And since income also includes profit from the non-operating activities of the enterprise, it is a broader term than profit. 20th term, profit. Profit may be gross profit or net profit. Gross profit is the difference between the revenue from sales or rendering of services over its direct cost. So sales minus direct cost of goods sold is gross profit. Net profit is a profit which is earned after allowing for all expenses, be it a direct expense or an indirect expense. So the total of sales minus the direct cost of the goods sold is gross profit, whereas net profit is the profit which is earned after allowing all possible expenses. 21st term, gain. It refers to profit earned from irregular or non-recurring nature, that is from activities which are incidental to the business. So it is gain is profit arising due to activities which are incidental to the business, not directly related to the operating activities of the business. For example, when you sell fixed assets or investments and make a profit, we refer to it as gain. 22nd term, loss. Excess of expense over revenue is called loss. So, loss is equal to expense minus revenue. We also say it's loss when we lose money or money's worth without receiving benefit. For example, when goods are lost by theft or fire. So goods lost by theft or fire, we refer to that as loss. When we get a loss from events which are non-recurring in nature, such as loss on sale of fixed assets and investment, then also we refer to it as loss. When we sell fixed assets and investment and get a loss, we refer to that as loss. 23rd term, the last term in this video, revenue from operations. This refers to revenue earned by an enterprise from its operating activities. So, all revenue earned from the main operating activities of the enterprise is called revenue from operations. For a trading company, it is sales minus sales return. And in the case of a financial company, it is interest earned and dividend earned. So, all revenue which is earned from the main operating activities of the enterprise is called revenue from operations. In the case of a trading company, it is net sales, that is gross sales minus sales return. And in the case of a financial company, it is interest earned and dividend earned. So we've seen a few more terms in this video. We'll cover the rest of the terms in the successive videos.